For the past year or so, I've been talking about the freedom that comes with achieving coast fire. This is when you accumulate so much in your retirement investment accounts that you can simply coast to your desired retirement income level without contributing anything more to your account. When you're not worried about additional retirement contributions, you can focus on other family and lifestyle priorities. But with the market downturn as of late, is the idea of coast fire still a possibility? In this video, I thought I'd share some details of our family situation, and maybe that will help you as you run the coast fire numbers as well. Hey everyone, this is Andy Hill from Marriage, Kids, and Money, a channel dedicated to helping you strengthen your family tree so you can live financially free. If you like what you hear today, please consider giving me the YouTube triple thanks. That's hitting the like button, subscribing to the channel, and then commenting down below. Also note that all the links mentioned in today's video are in the description. Thanks. Last fall, I published some content about our family achieving coast fire. We had accumulated around $550,000 in retirement accounts. Those are tax-advantaged accounts like the 401k, IRA, and HSA. At that point, if we didn't contribute another dime to our retirement accounts, we could expect to have around $2.1 million by the time we retire at 60 years old. This assumes a 7% growth rate over 20 years' time since we're around 40 years old. Using the 4% rule, our $2.1 million could provide us with $84,000 per year in income that's adjusted for inflation. Given that we live comfortably on around $70,000 to $80,000 per year now with 2 kids in tow, we felt very comfortable with taking our foot off the gas of retirement contributions. Things got even better with our retirement account balances over the next few months as the year concluded. Looking back at our family net worth chart, we had around $600,000 accumulated by year-end 2021. Recently, with the stock market going down significantly, our retirement investments have gone down significantly as well. Although we were diversified amongst different asset classes and even within asset classes, our portfolio has still taken a major beating. As of the time of this recording, our retirement portfolio has gone from $600,000 in December 2021 to $530,000. That is a $70,000 drop in about 6 months. Regarding our coast fire calculation, not only have we lost $70,000, but we've lost almost a year as well. According to my favorite compound interest calculator on investor.gov, our projected retirement nest egg at 60 years old is now closer to $1.9 million instead of $2.1 million. That makes our projected retirement income $76,000 per year instead of $84,000 per year. It might not seem like a lot, but we've gone from surplus territory to sufficient territory. If the stock market continues to drop, our projections will continue to look even more grim. To combat this grim future outlook, we'll be doing the following to keep our coast fire dreams alive. Number 1, realizing this market volatility is normal. I definitely love when the market continues to rise and rise year over year, but the reality is it can't last forever. The growth over the last decade has done amazing things for our family. We've become 30-something millionaires and achieved coast fire at 40 years old. But long-term investing comes with its ups and its downs. And this is a downtime. Depending on how things go, we could see ourselves in a recession and a bear market. That's an extended period of time of price declines that would severely affect our portfolios. The good news is that they are normal. And according to SeekingAlpha.com, the average length of a bear market is 289 days. Bull markets, on the other hand, average 991 days. So if we hold and continue buying more shares, if we choose to, then our good market days will outweigh those bad market days by more than 3 times. That's where we get our average stock market return of 10%. If you stick with it and don't sell, the positive days outweigh those bad ones. Number 2, continuing to contribute. While stopping retirement contributions completely sounds nice and relaxing, I will more than likely continue contributing to my Roth 401k. Additionally, we've been buying shares in our taxable brokerage accounts as well. I have a midterm goal of creating an account in my 50s that funds annual family vacations. Wouldn't that be cool? I've been doing this with my new M1 Finance account for the past year, and it continues to grow despite the recent downturn. These continual contributions will allow us to buy less expensive shares during the downturn. For example, when I started my M1 account in October, I bought a share of VNQ, which is Vanguard's real estate ETF, for $101. That same ETF is going for $95 as of the time of this recording. Another example is VTI, Vanguard's total stock market ETF. The price at the time of this recording is the same as the price as it was in January of 2021, more than a year ago. So essentially, we're getting stock, index fund, and ETFs on sale. Number 3, realizing we won't need as much retirement income. According to Investopedia, most experts say your retirement income should be about 80% of your final pre-retirement annual income. That means if you make $100K annually at retirement, you need at least $80K per year to have a comfortable lifestyle after leaving the workforce. So even though we're living off of $70,000 to $80,000 per year now, we might not need all of that in the future. Our kids will be out of the house, the college situation will be taken care of, no summer camp bills, no soccer enrollment fees, more money for us. Yes, healthcare costs will probably continue to go up and up, but our health savings account, or HSA, with Lively is helping us to be prepared for that reality. If you're interested in learning more about Lively and investing with triple tax advantages, check out the link in our description. Number 4, admitting that there will be some type of Social Security for us. According to GoBankingRates.com, by 2035, the number of Americans 65 and older will increase from about 56 million today to more than 78 million, putting a greater strain on Social Security. With those additional costs, I believe it's likely that the amount of money that we're being told we'll receive will end up being a lot lower. I don't think the program will completely go away. With so many Americans not ready for retirement, removing Social Security would be a major national disaster in our country. Given that, I do feel like we'll get something. Maybe not $30,000 to $40,000 like we're projected to receive as a couple, but it's going to be something. If you're wondering how much you're projected to receive for Social Security, go to ssa.gov and check it out. This information could help you on your Coast Fire journey. Number 5, continuing to control our expenses. With inflation high and the stock market low, it's important for us to continue to analyze where our money is going. As a couple, we do this through Mint. I categorize expenses through the Mint app every morning for about 5 minutes. My wife and I get together once a month for a larger budget party where we discuss what we spent last month, what our plans are for this upcoming month, and how that aligns with our future goals. This meeting helps us stay on top of where our money's going and if our spending patterns match up with our family plans and goals. To save some money lately, we switched our cell phone providers from Verizon to Tello Mobile and saved around $40 per month. This might not sound like a lot of money, but close to $500 per year for pretty much the same service is a big deal when our income is a lot lower than it used to be. Number 6, increasing our income. For the next 6 months, while my wife is going back to school, I'm looking at ways to grow my income through my small business. Diversifying and growing my income in the past has been my ticket to achieving major financial goals like becoming debt-free, mortgage-free, and achieving Coast Fire, as we're talking about today. Since I'm still fairly new to this entrepreneurship world, I'm still learning every day about how to grow my income. It's a fine balance, but I am working on it. This past quarter, I was able to give myself a raise up to $65,000 per year. Woohoo! If I continue to perform well and grow my small business revenue, I may just give myself another raise next quarter. We'll see how I do. With those additional funds, we'll be able to travel more, give more, have more fun, and of course, invest more to ensure our Coast Fire dreams stay alive and well. In the end, the idea of Coast Fire is one that our family enjoys very, very much. The freedom and flexibility that comes with never needing to make another contribution to your retirement is very relaxing to us. For a couple in their late 30s or early 40s like us, it's incumbent on us to make our own pension. That's what Coast Fire is to us. As long-term investors, I believe we'll be just fine over the next 20 years as we make our way to retirement. Continuing to buy and hold will be our plan, and I believe it'll pay off in the long run. Enough for me, everyone. I want to hear from you. What do you think of the concept of coast fire in the midst of a market downturn? Are you working towards this goal personally? Please let us know in the comments below. Also, know that all the resources that I mentioned in today's video are in the description. This is Andy Hill from Marriage, Kids, and Money, signing off. Carpe diem.